Hello, my name is Ethan Wrenn. Make sure to check out my website, ethanwrenn.com. From there, you can find links to all my various socials. We are currently live on Twitch, YouTube, and the front page of my website. If you'd like to get notified when we go live next, make sure to follow or subscribe, and you'll receive that notification. You can be here commenting on the video. Before we jump into things, this is my website. On my website, we have a blog. You're able to access my Discord, and I'm constantly updating the blog with new articles pertaining to finance, whether it be ETFs, companies, gaming, emulation. It's regularly being updated with new and current information. It's quickly becoming one of my primary outlets. So if you guys could check that out, I'd highly appreciate it. The video we're going to be jumping into today is how to track inflation using CPI, PCE, and PPI indexes. Let's learn more.
Policymakers, businesses, and investors all keep a close eye on inflation, which is the rise in cost of goods and services. A little bit of inflation is a sign of economic growth, while too much inflation can hurt the economy. But with millions of goods and services bought.
Note what he just said, guys. It's common a misconception that inflation is this awful, horrible thing, right? Inflation is a constant. It's always happening, and this idea of we need to bring inflation down, It's this rate of inflation. They don't want inflation to go to zero, and it never will go to zero. It'll always be a positive number, roughly in maybe a 2% range people would consider healthy. But inflation is a constant that's always happening year over year. It's just the rate at which it's happening that's often the point of contention.
And sold every day, how do we actually know how much things cost across the whole economy? That's where the inflation indexes come in. Inflation indexes gather price data from various sources across the economy and compile them into one number to give a snapshot view of how much things cost. Seeing how much and how quickly prices are rising or falling can tell you a lot about economic growth that drives financial markets and your investments. There are three main inflation indexes that we'll focus on: the CPI, or Consumer Price Index, the PCE, or Personal Consumption Expenditures Price Index, and the PPI, or Producer Price Index. Each inflation index is compiled and calculated differently and has different purposes. Let's start with the Consumer Price Index, or CPI. The CPI is released by the U.S. Bureau of Labor Statistics, or BLS, every month. Simply put, it's a measure of Americans' purchasing power and is used by policymakers to understand the cost of items over time. To calculate the CPI, the BLS creates what's called a basket, or collection of goods and services representing things the average American buys. The main basket is divided.
So take notes, guys. Take notes. This part's kind of important when it comes to understanding inflation. A typical gauge used for understanding inflation is, again, the CPI. And the CPI is calculated based on these average prices across each and every one of these sectors, right? So they'll take, the average price of transportation, the average price of housing, the average price of apparel, and all these different things. And then once they calculate it, they come to a single number, which represents your CPI. Now that you have this understanding of how CPI is calculated, you can also kind of get an idea, how would we enter a time where the CPI is coming down or increasing? Well, a decrease in the average transportation cost would drive your CPI down. A decrease in the average medical care cost would drive your CPI down. A decrease in your average housing costs would drive your CPI down.
Divided into sub-baskets like housing, food, and clothing, which are weighted based on importance and then averaged to find the overall CPI. For example, the CPI in January 2022 rose 0.6% and up CPI in January.
Also, just wanted to pause on this screen specifically to show the different weightings and the different important variables being assigned here. So housing represents 42%. I feel like that's kind of a great note to take. Are you guys taking notes, Jet?
For example, the CPI in January 2022 rose 0.6% and up 7.5% year over year. This dramatic increase was fueled by a combination of supply chain issues and economic stimulus related to the pandemic recovery. However, of the 8 baskets the CPI tracks, the 2 that rose the most from January 2021 through January 2022 were food, which rose 7%, and
look at this screen, guys. Now this makes sense. This video is relatively up to date, right? So he's talking about January 2022, which is right about what you would expect, right? So look at the number one driving indicator of inflation. Look at the number one driving indicator here. Look at the number one driving indicator here. Energy prices. All these other things, I mean, these aren't even that bad. These really are not even that bad. Again, if you expect your average, like, not average, the ideal rate of inflation to be roughly in that 2, maybe 3% area, like, food isn't that far off from 2-3%. All items minus food and energy, like, we're just over 6%. Like, that's not far off. That's not far off at all. The one thing dragging it is energy. It's almost like you have a choice to make as an investor, right? You can invest in everything that the world has to offer. Every company, all these great things, all these ETFs, all these sectoral ETFs, all these different countries. But by loaning any merit to the energy sector, you're actually just completely shattering your own argument. It's you at least in its current state, by being bullish on energy is the equivalent of being bearish on literally every other asset in the world, which is, I've known this forever. This picture really demonstrates that how destructive this idea of these inflated energy prices is to our overall economy. If this one figure were to just magically just go down significantly, this would dramatically decrease the rate of inflation here in our country. Now, we have this common misconception of Mr. Powell. He keeps punishing the consumer by increasing interest rates as if that's the core problem to this inflation argument. As if us buying our basic necessities is the problem. It's kind of insulting in a way when you look at it, right? You have this price gouging happening in the energy sector, and and his only solution, his only tool that he feels he has is punishing the consumer by making it harder for them to buy their inelastic and elastic goods, right? Making it harder for them to buy their just basic necessities that they need to be able to get to and from work, to feed their families, right? All these other verticals, housing, right? He's increasing interest, like, it's a farce, really. It's a farce. And by incorrectly diagnosing the problem, it makes it impossible to implement a proper solution. You need to be realistic here and realize interest rates and their impact on inflation is just null and void, because the real problem here is this over exuberant price gouging that's happening in energy. Now, this was January 2022. I'm not sure if you guys are familiar with what has happened since then. But here's a video we made in February, and it was talking about, again, the energy prices. And at the time this is a 2-part video. It's from that time we shorted series. And as you can see, we were talking about this insane price gouging happening here in natural gas, for example. We stated that natural gas never maintains a price of this point or higher throughout its entire price history. It's only ever been at this price for less than like 2% of its entire price history. And we were projecting as much as a 80 to 90% move to the downside from these crazy natural gas futures. This was the problem. This was the problem the entire time. This bubble that they created in energy prices is directly what caused inflation to climb. Now, if you wanted inflation to actually go down, like if you actually cared, you would have attacked it at the core of the problem, which was these energy prices. And what did we do? We went short on natural gas. We were projecting as much as an 80% decrease in this time frame. Look at it. It's happened before multiple times. Let's go to the current time frame in this video. This is what proceeded to happen. We successfully shorted natural gas by as much as 80%. This is the weekly chart. We were showing the monthly. here's the same time frame for you guys. So you were looking at a monthly. This is still the monthly. It tanked after we made the video. It tanked from $9 to $2. From $9 to $2. Now, again, this happened February time. January, February, this is exactly when this video is being made and talked about, right? January, give or take, right? Give or take. But you would only expect, now having seen this massive decrease in these energy prices, for it to also get factored into this CPI, bringing down this singular bar, which was causing this huge drag on CPI to increase our rates of inflation. If you really want to see inflation come down, you need to attack it at the core of the problem. And it's clearly the price gouging that's happening in the energy sector. It's very much a problem. If you're a bullish investor and you hold millions of dollars in stocks and all these different companies, both domestic and abroad, and you're pumping energy, you're actively hurting your own position, right? Like, these are two contradictory things. You can either have access to everything that the world has to offer, or this one earth polluting thing. If you want inflation to go down, you want your stocks to run, well, you want energy prices to go down as well. These are the same argument, the same side, it's the same team. Moving forward, again, we already successfully shorted natural gas as much as 80%, which was awesome. I highly recommend going to watch this video on my channel to learn more about how that played out. But what I've noticed is currently natural gas prices are sitting at roughly like $2 flat. It was $2.50 here. They were sitting at roughly $2 flat. But this price gouging that happens when I go to my local gas station, and I live here in Ohio, right? It's not like I live in a very liberal state with high prices like New York or LA, right? You know, kind of like Texas, kind of like Ohio. We have relatively good prices for energy, right? And when you see these movements in futures, you see changes in prices at the pump. But natural gas futures trading at roughly $2 per, but the prices at the pump are still above. They're what, like 320, 330, which is high, which is really high, guys, which is really high. Why is it that the commodities are being traded at $2 per, but when we go to the gas station, it's still above 3? This is a problem. People should be running class action lawsuits against these energy companies, because it's ridiculous, guys. It's ridiculous. You are actually getting gouged at this point. The value of this asset has tanked, and it is at $2, but they are still charging significantly more, as much as 50% over that. It's crazy. It's crazy. Here's a current chart of, let's see if it'll load here. Here's a current chart of IEO. This is U.S. oil, gas exporters ETF. So this is a sectoral ETF, which we talked about earlier today. And this is the energy ETF. And look what's been happening here, right? You have this clear resistance. You have this clear support level down here. You've had two prior examples where the entire energy sector has tanked from this price point. You have this double top forming very similarly to other double tops you might have seen created on our channel. You have this downward sloping red, and that's as much as what, like from a price point of $85 down to $30. That's over 50% downside. So that's just something to keep in mind, the current state of the energy markets as a whole. While natural gas has sold off significantly, and they were kind of the leader of the energy sell-off, I see it next in oil. I see a massive decline coming to oil, and I see a massive decline coming to oil and gas companies as a whole. Again, you would know about that if you're in our Discord. And also on our Discord, if you come down to this economic data monitors, we have monitors for news, market quotes, economic data. But if you open up the economic data and then click on Consumer Price Index, this is updated regularly. I think it's every 2 weeks. And it'll show you the current CPI, right? So this is January, February, April CPI right here. And then you can see what it's been like for the past 2 years, right? It shows the history, and it's regularly updated. So that's a good way to monitor CPI via our Discord. Let's go back to our video. I know I spent a lot of time talking about this, but it is important because you hear about, oh, we need to fight inflation by increasing interest rates, even though that has little to no effect, because the core problem is this clear price gouging that's been happening in the energy sector with these insanely inflated prices that were never just and never made sense. And if you really want to solve the problem, again, you want to be bearish on energy commodities. You need the price at the pump to reflect it. The fact that, again, natural gas prices have come down as much as 80%, but we, the consumers, don't see that and are still being gouged hand over fist, that's a problem. That's a serious problem. Like a federal, like there should be court, like people should be looking into that. Why is that happening? If we just see oil start to come down, you will actually start to see inflation rates improving, coming down to that nice healthy level of maybe 2 to 3%. And then again, stocks are going to continue to run. If you're bullish on markets, you're bearish on energy commodities. I just want to put that out because I see these convoluted ideas of people mixing assets together that don't go together unknowingly.
And energy, which rose 27%. The CPI is used in a few ways. First, it's used as a cost of living gauge to determine government benefits like Social Security, food stamps, and pensions. It's also used to adjust Treasury inflation protected securities, or TIPS, a type of government bond where the principal changes with inflation. Another common inflation index is the PCE, or Personal Consumption Expenditures Price Index. The PCE is released monthly by the Bureau of Economic Analysis. It's similar to the CPI in that it measures the price of goods and services, but it weights the baskets that comprise it differently. Where the CPI checks in on 80,000 products, the PCE pulls its data from the Gross Domestic Product report.
This is the key difference. Make sure you jot this down. The difference from CPI and PCE is the weighting of these various baskets of goods,
representing 100% of the U.S. economy, including nonprofits and corporations. The CPI is susceptible to large swings from one basket, whereas the PCE's formula smooths out the data. The PCE also accounts for consumer behavior changes in response to rising prices, making it more accurate than the CPI. Because of this, the Fed uses the PCE as its primary inflation metric when determining monetary policy. Traditionally, the Fed targets an inflation rate of 2%, which is in line with healthy economic growth and price stability. When looking at the PCE from 2020 through 2021, you'll see there was a sizable drop in spending due to the pandemic. 2021's results show Americans spent more year over year in a lot of sub-baskets, but more so on energy. For example,
but more so on energy, guys. Again, if you want inflation to come down and you want your portfolios to run, you want energy prices to come down. These arguments run in tandem. They all everything correlates. Everything on our channel correlates in one way or another to everything else. If you don't know better, you could very easily find yourself advocating against yourself just by the way these different things you choose to support. It's crazy. Also, I just want to look at this chart one more time. Look at how gradual of an increase this was since 2021. Again, we are in year 2023, guys. So it's not like this is a problem that just happened overnight. Let's keep this in mind. Inflation didn't just magically become a problem. It started as far back as 2020, where you saw this gradual increase over time. And it's not like this increase in inflation has had a negative impact on markets. That's also a common misconception, right, with inflation. And inflation is when cost of goods go up and assets go up. You know, assets like a house. A house is an asset. So when inflation goes up, it means the price of your house is going up. Stocks and commodities are assets. Stocks are assets, right? ETFs are assets, investments are assets, right? So when inflation's going up, your assets are increasing, right? And if you look at the U.S. stock market between this period and this period, there was 100% growth. There was 100% growth in the SPY. Let's see if I can bring up a chart real quick. Oh, that's perfect. That's perfect. Um, um, so between 2020, this dip right here is 2020. 2022 is right here. So as we went from 1% inflation all the way to a 6, you saw stocks run as much as 100%. Again, this is the SPY monthly, and look at that beautiful crossover we just did on the monthly 20 moving average. The SPY went down and went right above that monthly 20 moving average without a problem. It did take a minute. Well, I guess you could say it took a while, but it definitely happened. It definitely happened. And this, you could say the same thing about QQQ, right? 2020, rising inflation, 2022, which is the end of this time frame, 2022. Look at that. Over 100% growth, 100% growth and rising. So to recognize now, here we are in 2023, inflation's maybe like right here. And one thing I just wanted to point out with this chart, also look at that monthly 20 moving average on QQQ and how we have bullishly crossed over it and should see continued growth here. I just wanted to point out those charts. We've been looking at those in the Discord. If you join the Discord, you'll be able to see those, be a part of those conversations. I highly recommend joining the Discord.
More year over year in a lot of sub-baskets, but more so on energy. For example, a combination of reopening economies and OPEC choosing to limit supply caused gas prices to soar. Finally,
no better reason than an oil cartel named OPEC just we want to constrict supply. We want the prices to rise. Like that's the type of greed and price gouging that I'm talking about. Like I just can't support it. I can't support it. OPEC's an oil cartel. You know, they fix prices. That's definition cartel. Can't stand them.
Finally, there's the Producer Price Index, or PPI. The PPI is released monthly by the US BLS, so where the PCE and CPI are measuring the experience of consumers, the PPI looks at what's going on with the producers of goods and services. It's created by 25,000 establishments, sending approximately 100,000 price quotations every month. The PPI is calculated by dividing the current price of items received from wholesale sellers of products in a given basket by the prices of those same products in a base year, which is 1982, and then that number is multiplied by 100. The information is useful in a lot of ways. Producers can compare prices of a given product or industry to inform their pricing strategy. It can also be used to foreshadow price changes for consumers. The assumption being, if producers are paying more for wholesale, there's a higher chance consumers will pay more for retail items. The government uses the PPI to inform its monetary and fiscal policies aimed at limiting inflation. From January 2021 through January 2022, the PPI saw a wholesale price increase of 9.7% across the board. It shows that businesses paid a lot more for their goods than they did pre-pandemic. If businesses are paying more, the extra expenses could be passed along to consumers, which is what we're seeing in both the PCE and the CPI. I want to mention there are different variations of each of these indexes that alter one variable or another. So if you're interested in learning more or want to see how small tweaks alter the results, there's plenty more data to comb through. For example, each sub-basket that comprises the CPI has its own index. It's also important to point out how volatile the baskets of food and energy have historically been. Both baskets can swing violently in either direction, making long-term trends difficult to discern. Some economists look at core inflation, which strips out food and energy because core inflation tends to be more stable. So what does inflation mean for your portfolio? In the markets, high inflation is typically bad for fixed income investments like bonds or dividend stocks. That's because the fixed payments are now worth less due to a decrease in buying power. When inflation is low, you don't lose buying power, so investors are happy with their fixed payments. On the flip side, high inflation is usually good for value investing. Value stocks are companies trading at a lower price than what the company's performance, the actual bottom line, might suggest. Value stocks can have high dividend yields, low.
If you've been following my channel, you know we've actually been looking at multiple different value-weighted indexes. Let's see if I can bring that up. For example, we have IWN, which is the iShares Russell 2000 Value ETF. This is something we just posted 11 days ago. I highly recommend looking at it and potentially investing in it. And he's saying, again, that's a type of ETF or a type of a value company could perform well even during high interest or high inflation periods.
Low price to book ratios and low price to earnings ratios. Value stocks may perform better in inflationary environments because the value of their earnings is more current than their growth counterparts. Further dated earnings tend to erode faster, so growth stocks may underperform.
In time periods of, again, high inflation, you would expect growth stocks to underperform. Note that those are some important characteristics.
The CPI, PCE, and PPI together can paint a picture of inflation in the United States. Investors can use the information to investigate broader trends in different sectors. They're another useful tool in your investor tool belt.
That was another useful video from TD Ameritrade's official channel, and I think that was a great video. I feel like topics such as inflation and interest rates and all of this has been quite topical recently in recent news cycles from various outlets, so just want to make sure we covered that a little bit for potentially new or maybe less experienced investors potentially look into it and see how all these things correlate. And we brought some really good points to the table on how value stock can perform better in periods of high inflation, and how there's really one aspect of inflation that's really dragging the whole thing higher. And if we could just focus on bringing down the price of that particular expense for the end consumer, that would drastically bring down inflation, which I think is a goal right now of our government. And they could potentially stop increasing interest rates, making it harder for us to get loans, punishing the consumer when it's really not our fault, when really the consumer's getting punished by getting gouged when they try to fill their car up, and then they're getting punished again in an attempt to solve the problem by making it harder for them to gain access to money, right? So that's everything we have to say. Next video.